2 weeks from now, shareholders of Sona Petroleum will have to decide on its Western Australian oil asset buy. However, share price hardly seemed to react after the announcement. We speak to MD Dato Sri Hadian Hashim to see if he's concerned. Thank you, Hadian, for joining us today. Now, first of all, share price did not react last week after the announcement, right? It was quite muted after the announcement. Now, are you concerned that the shareholders might not opt in for the oil asset buy?
We are coming at a very low oil price, right? Oil price scenario. Not only is it a low oil price scenario, the cost of doing business is low because the cost of services, cost of material, and other things that you need, including the hiring of the rig, vessel, helicopters, what else that's required to carry out our development progress are coming at a low. Now, the reason why, so you can never come at a time when the oil price is low. You get, well, asset price is low. If you then compare to what we had with Salamander, the asset price was purchased per 2p barrel of about 20. Here we are doing it about 147.
So you also managed to slash the purchase price by 50%. So could you actually secure the price earlier on when you started talking to the vendor in Australia?
When oil price dropped to below 30, it necessitated us as Sona to relook at, is this a doable business? So what we have done, looking at the forward curve and available information, including checking the price going forward for the Brent crude, which is a reference crude in this case, that you benchmark the price that you the forward price with the oil companies, with the independent technical consultant, and also what the view of the brokers are in town. So for the $25 million US dollars purchase price was based, or at least derived, from mid-30s oil price this year, mid-40s next year, and about mid-50s subsequent year.
But at the end of the day, are you actually concerned that shareholders might not opt in? You know what happened to Click Energy recently? They are looking for liquidator, they are liquidating their shares. Are you concerned that in the entire SPAC market, investors are getting a little bit jittery about SPACs?
In our case, the case for Australia, it's a very transparent system, right? A good place to do business in the fact that you can at least, the country risk is fairly low. I think equally important is you speak the same language.
If oil prices drop below US dollar 30 US dollars a barrel, what are you going to do? Are you going to cut production?
The shellers in the American market are affected. Production has been cut down, and also the high producers are exiting the market. And a lot of this, when I say high producers, these are essentially the non-OPEC countries, and that include oil companies in Norway, oil companies in Europe, and oil companies in America. Nobody is going to produce oil below their costs. If at the end of the day, oil price is below $30, not only is the Sona proposal not doable, most of the companies, the high producers company, will shut down. There will always be demand because you've got population increase, people need to still run in, right? Plus the fact that you have cut CapEx, you have cut your costs, so production is going to be affected. So if you then compare the demand versus what you have accessed by the end of 2016, we're going to be into negative territory as far as access in the market is concerned.
According to the circular, the purchase consideration of about $25 million US dollars a barrel was made on the assumption that you will be able to get production license to extend by the authority. So what happened if you don't get it from the authority?
In the case of a concession system in Australia, where it is commercially driven, so the concession is yours. So if you can continue to prove that there is a recoverable reserve that can be economically produced, there's no reason for the authorities. And what we have also done is look at the landscape in the Australian, whether there has been any precedent cases where licenses are not renewed on the basis that it's still economically viable. The answer is no. So we are very positive that on that alone, the production license will be extended.
Drilling expenditures was you plan to put in about 147.4 million Aussie dollars, which is about 435 million ringgit Malaysia. Now, total together with the amount that you're going to purchase for 100 over million Aussie dollars is about 538.2 million ringgit.
Yeah.
So it's slightly more than the price tag, slightly more than the proceeds that you raised during IPO. Are you going to borrow any money, or are you going to have a cash call to finance the expenditures?
So we have enough money to spend to carry on our first phase of the development. Now, as for the second phase, so what you have is you got revenue from what you're producing, and you still got access, assuming the deal goes through, that additional 25 million. So between that, I do not see just yet whether any money would be required to carry on the second phase.
So coming back a little bit to Click Energy company, they say they're going to liquidate the shares, right? Do you see interest from other SPAC investors coming into Sona Petroleum?
I suppose for any investors to come in, you must have a value proposition going forward. Do they believe in your model? Do they believe in the people that's coming forward? And most importantly, will there be any upside in this business?
When do you actually expect Sona Petroleum to graduate from SPAC after Hibiscus?
Well, it would be as long once you get a QA approved.
If it could get approvals from shareholders, Sona Petroleum will be the second company to graduate from SPAC in the country. All eyes will be on its EGM.